Good evening, everyone. Thanks for joining us today from wherever you are in the world. So, good afternoon or good evening. Welcome to our Wednesday weekly webinars. And these are our weekly webinars we do on a Wednesday. We do them at 7 o'clock every week and we cover lots of different topics. All our previous webinars are on our Joseph Mews YouTube channel. And as I say, lots of topics all to do with property investment. Slightly different format today. We appreciate everyone's time is precious. So just a handful of slides. I've got a panel which I'll introduce you to in a second of industry experts. And let's make it just nice and conversationally, and we'll have more of a panel discussion. And we'll have somewhere in the bottom there, you'll see there's a Q&A box, question and answer. So anything to do with property, just fill that in, and we'll be able to answer hopefully any questions that you have. Can I have the next slide, please, Han? Okay, thank you. So there's myself, Andrew Siegel. I'm managing partner, managing director here at Joseph Mews. I'll be hosting the webinar this evening. As we have questions, I'll introduce you to the different speakers, but I've got Liam Smith, partner and department head at Knight Frank, and he'll give you a little bit of background and tell you about his role and what he does and how we work with Liam. I've got Lee, so we can talk mortgages. Lee Adams from Peritus. Again, there's a lot of moving parts when you're buying a property, and obviously the mortgage, the financing is an important area. So we'll have a nice lot of questions and a panel discussion with Lee. And I've got Raj, letting expert from Martin and Co. Birmingham based, but can talk about anything nationally, really, in terms of the property market. And I've got Hannah, who's a sales manager here at Joseph Mews. And as I say, we've got a strong team. Raj, Liam, well, been working with these guys. They're all younger than me. You can see I'm old, but been working with these guys for decades. So a lot of experience and a lot of history, which we'll share with you this evening. If I could have the next slide, please. What I wanted to do, I can see we've got a lot of new people here today, as well as existing clients. So I just want to just give you 2 minutes, a little bit of history about us. So we were started by Andy Foote, who's the guy on the left, on the right there. He's our chairman. He started the business 2000, started property in 2000. He bought something off plan. It was overseas. He still got the property. He was bought it in 1999. It's been fantastic, but the customer care and that sort of customer experience wasn't very good. There was little or no communications, not a lot of transparency, different language, etc., etc. So when he decided to set up a property company, he thought wherever you're based in the world, we can make this a lot better experience. And we have offices. Headquarter in the UK is Birmingham. We've got an office in Dubai. We've got an office in South Africa. We don't sell properties in Dubai. We don't sell properties in South Africa. It's to support clients in those regions that are investing back into the UK. So we've got an excellent track record, simply because it's all about putting the customer care and customer service first and foremost, and our track record speaks for itself. So we're a sort of distribution partner for lots of big developers. We've transitioned into Joseph Mews, and as you'll see, we partner with various developers and property companies, and it allows us to access the best stock in the country and therefore offer that out to our investor clients. Next slide, please, Han. Just a little bit of showing off. We've delivered, we're up now probably to 4,500 units, not only sold, which is important, but delivered, handed over across 42, 43 developments. We get a lot of repeat clients. We help people build up their property portfolio. And as you can see, over £500 million of GDV. What does that mean? Gross development value. So that's the value of the developments, the apartments, the houses that we've delivered. Next slide, please. As I mentioned, we partner. These are household names in the development world. I'll introduce you to Liam in a minute, who'll talk a little bit about Knight Frank, and we'll ask some searching questions, hopefully. But Knight Frank, the JLLs, the Savills, they're multi-billion-dollar companies, research companies. So we do a lot of work with them on the research side, but also on the sort of sales side. I'll explain what that is a little bit later. And again, in the West Midlands, we've got Elevate, award-winning property developer. They've delivered 1,100 units. And again, what we look for is the best developments, the best developers that are well funded, have a track record in the best locations. And we'll talk about why it's important to sort of buy with your head, not with your heart, and look at these different locations. And again, yeah, very pleased to partner with these developers. And if I show you the next slide, the reason why we partner with these developers or the reason why they want to partner with us is, yes, we do the sales and the marketing, which is pretty straightforward. It's just selling property. A lot of people want to buy property. But as I mentioned, from a customer care side, if you reserve a property could be ready to go now. It could be off plan. So it might not be ready for 15 months. We get you to exchange. So we get you to exchange contractually. And then we provide to you and to the developer, we do all the customer care. So we do the handover, snagging, warranty work. We get you through to completion. We've got partners to help with setting up limited companies. And I'm sure we'll touch upon that as to why that could be beneficial to investors. Mortgage providers, company we'll hear from Lee shortly. Raj on the letting side. We've got furniture companies we work with. So it's one phone call, one-stop shop. So you love us, or investors love us, because we do all that work with you or for you. Developers love us because they can just get on and build, carry on with their day job, which is digging holes and putting up buildings, and we take care of all the customer care side. So it's kind of a joint venture with the developers, and it's a sort of perfect match, really. If I can have the next slide, please. Okay, so I'll get the guys to put their cameras on so we can see who we've got there. But just a little reminder, Q&A box on the bottom there. If you just click on the questions, any questions you've got, then we'll answer those running through. Liam, are you there? Raj, are you there? Lee, are you there? Let's see who we've got there. Fantastic. Brilliant. Okay, so we can put faces to the names and just see if they match up to their photo ID, which they do, which is great. So Liam, let me introduce you first of all to Liam Knight Frank. I've got a couple of sort of prepared questions which I'll cover just to kick things off, and then we'll hit the Q&As. But Liam, just give us a little bit of background on yourself and a little bit what Knight Frank do.
Yeah, thanks, Steve. Liam Smith. I'm a partner in Knight Frank. I head up our investment teams and the international project marketing department in the UK. My role in the business is to identify emerging markets outside of London and bring them to market with trusted developers and partners like Joseph Mews. We do a huge amount of due diligence on both the developer and the development, the location, the viability of the whole scheme, making sure they're going to yield on completion, and then obviously bring them to market with partners like Joseph Mews. Our relationship with Joseph Mews dates back many years. We've worked with them on many schemes. A lot of the developers on the previous slide are our clients that we've introduced Joseph Mews to, and they're very happy. I think the synergy between the global brand of Knight Frank and the customer services that Joseph Mews provide, both us, our clients being the developer, and Joseph Mews clients, the buyers, is exceptional, and that relationship continues to grow.
Yeah, I think it's quite interesting because you've got the developer, which could be Elevate. You've got Joseph Mews. You've got Knight Frank. So there's a lot of people involved. But I suppose, Liam, you would traditionally you'll supply consultancy to the developer, maybe help them with planning, financing, pricing, all those kind of consultancy services. And then normally, I suppose, is like a gentleman's agreement, because you've sold them the land and you've done all the work with them. Then they'll give you exclusivity on the sales, and then you sort of come to us for that because of what I mentioned earlier on all the customer care, the history, the experience. So it's a perfect partnership, really.
Yeah, 100%. We'll identify a piece of land for a developer. We'll help them buy it. We'll do the viability assessment of the actual build itself. It's a real end-to-end service, really, and we'll help them with their sales strategy, and the delivery and the exit for them. Like you
Perfect.
say, you form a big part of that globally through your UK offices, Dubai, South Africa, and other areas or hotspots in the world.
Nice
It
one.
works very well.
Cool. And I've got just a couple of questions to kick things off. If you compare investor behavior this year, are people still chasing cities like London, or has affordability pushed those investors, I guess, further north?
Yeah, I think investors' sort of appetite for um, better yielding products has probably been not just in the last 12 months, it's been going on for many years. Obviously, the change in stamp duty for international buyers, there was an extra levy on that, and also second homes tax for UK buyers and international, made buying in London very expensive upfront. You know, it's a big tax bill to fork out. The only reason you'd really be paying those high prices in London is for the capital growth. And when you've got companies like Savills, JLL, Knight Frank, and other big PLCs across the globe saying that our projections for the regional cities are actually better than London in terms of the growth of the property prices for the next 5 years, it doesn't really make any sense buying in the capital at the minute. So, you know, places like Manchester and Leeds in the north are very good, and obviously Birmingham as well. And yeah, we've seen that sort of transition from the majority of buy-to-let investors sort of looking at the regional cities as opposed to London. Of course, you'll always have that core market of buyers that will only buy in London because it is London. And don't get me wrong,
Yeah.
and it's still a very good investment, but very much for the future. Um, I think certain regions in the world, you know, certainly China, Hong Kong, those kind of areas, their buyers are still very, very keen on buying in the capital. But I think for the vast majority where it is price led and budget sort of dependent, they are looking for a better yielding property. So
Yeah.
you
Yeah.
know, you've seen the prices go from 160 for a one bed in Birmingham to 250 to 300. That's still considerably cheaper than a 650 grand tiny little pokey apartment in Zone One London that won't yield as well.
Yeah. I think London, as you say, is London. If you think buying property in America, you think New York, Australia, you think Sydney. And I think it's kind of for me, it's more of a trophy asset. As you say, average price in London, 657,000, average yield 2 or 3%. Where you go further north, just to blow our own trumpet, we got apartments from 150,000, giving a 7% yield. So yeah, it's about, yeah, people want London, happy days, it's London. And if you're in it for the long haul, it's good. But yeah, we're seeing the same. Further north, lower price point, better capital appreciation and better rental yields. And I know, again, with the JLLs, the Savills, and of course your reports, the Birminghams, the Manchesters, Bristol to a certain extent, they all come out with all your research. They're all coming out the best places to invest in the UK.
Yeah, yeah, that
And I
pacing
think
the capital by quite some distance.
yeah, and I think it's important. It doesn't really matter where it is. I've got clients from all over the world. We've got clients who've never been to England. So the management, the furnishers, the mortgages, the letting, it's all sort of taken care of by us. So you don't have to be there. You never even need to go and see it. So we say buy with your head, do a lot of research. We've got tons of guides and research and the likes of Liam and Knight Frank. There's tons of information out there. So it's good to do research because you can go to an area that will just give you 0.5% more capital appreciation when that's cumulative over the years with the price of property we're talking about. 0.5% might not seem a lot, but it can be tens and tens and tens of thousands of pounds over the 25 years or however long you're holding the property for. Brilliant. Thanks for that, Liam. I'm sure we'll come back to you in a minute. Let's get Lee on. Let me introduce you to Lee. So, independent mortgage advisor with Peritus International. So, we use Lee and have done for a long time in his company for clients based in the UK and of course anywhere in the world. Just give us a little bit of background there, Lee, on yourself.
Andrew. So my name's Lee. I head up Peritus International with my business partner Faye. In a nutshell, we're able to help clients that are based globally, so you can be any nationality in any country. Gets a little bit awkward if you're sort of in a sanctioned country, but there are still lending options available to you. Um, we're able to help clients fund purchases of any property, so whether it's a new build flat, a house, an existing property, a commercial property, for any particular use. So it could be short-term let, long-term let. It could be a holiday home in the UK if the client's looking to do that, or if they're looking to perhaps buy a commercial property, could be offices and things like that. And also, we do help a lot of portfolio landlords as well. So if you've got clients that want to, let's say, raise some money on their existing properties to help them buy other properties and increase the portfolio, we can help with that as well.
Brilliant.
As I said, independent, so we're not limited by the lenders that we use. And yeah. So there's not many clients, put it in a nutshell, there's not many clients that we can't help.
Yeah, I think I think it's something over 90% of our clients are mortgage clients, and even if you've got cash, it probably makes sense to leverage, depending on your views on borrowing. So that can work quite well. And again, the UK is the most invested property market in the world. Easy to get mortgages. I think a lot of overseas clients don't realise that you don't have to be in the UK, and that's where Lee comes in. Everyone's sort of situation's different. So at the end of the webinar, you'll be able to click on a box. So if you want Raj, and I'll introduce Raj in a minute, Lee, Liam, or myself to talk to you about, property investment, our investments, which I'm not really going to talk about what we're doing. I'll give you a little teaser, but let us know, and obviously we'll all be in touch. So a question for you, Lee. Given talk of possible rate cuts, well, by the end of 2025, rising incomes, hopefully, do you expect mortgage costs to ease for investors? Give me a little bit of background on the rates
64,000
and
on the
what you think.
question. Yeah, it would be
Yeah.
nice to think so. Yes, I think with all the reading that I've done, looking at the media, what lenders are saying, economists, I think most people are sort of assuming there's going to be a rate drop to 3.75 in December. I think it's December the 18th, the decision. I think there's a 90% chance of that happening based on what I'm seeing myself. And then long term, well, the end of 2026, potentially being around about 3.5% when we get to the end of next year. Rate wise, it would be nice to see. As I said, I deal with a lot of international clients. It would be nice to see their rates sort of towards the low 4%, and let's say the traditional UK client base in the UK, let's say buying in a limited company, a new build apartment, it would be good to see their rates sort of less than 4% as well, sort of 3.75, 3.8%. But the big thing is as well, it would be nice to see the fees that are involved in a lot of the mortgages reducing as well. So that I think clients would sometimes want lower fees than the potential drop in interest rates, because some of the fees are quite high on some of the mortgages. But if we can see that, that'd be really good news.
Yeah, and I know we were talking about a particular client, and you can get rates, reduced rates quite lower than the threes and the fours,
Yes, you
but
can.
you're paying a fee, a percentage on that, which can be quite high, but that can be built into the mortgage or is built into the mortgage. And again, I suppose probably quite a simple calculation, isn't it, to say, yeah, it's worth paying X percent to get a 2.5% mortgage, and that's where you come in to help and advise, depending on short, mid, long term strategies, I guess.
Yeah, just think of it as buying the rate, and there will be a cost to that, which 99% of lenders will allow you to add that onto the loan.
Cool. Interesting. All right. Thanks for that. So stay on, and I'm sure we've got some more questions. Let me introduce you to Raj. Last but by no means least. We've been working with Raj for decades, and yeah, just give us a little bit of background, Raj.
Yeah, so I'm from Martin and Co. So Martin and Co is a estate agency across with 150 offices across the UK, all franchised offices. So I own the franchise for the office in Birmingham City Centre and also in Harborne. So we've been operating for 13 years, and although we do sales and lettings, our main forte is lettings, and we are quite active in the Birmingham city centre market.
Excellent. And let me kick you off with a question, Raj. So recent data shows average private rents in the UK rose 5.5% year on year, average 1,354 per month. That's according to September 25 for rent. Do you think rental demand will stay this strong next year, or are we reaching a ceiling? What's your kind of recent history and sort of predictions for yield increase, I guess?
So post-COVID, rents just increased at a rate that was just a crazy rate, and basically over that period, each year on year, we've probably been seeing 5% increases, probably even more in Birmingham city centre. And it's got to the point now where them rents were just unsustainable. They're becoming unaffordable. So the rents have kind of stabilized. And I
Okay,
do see that kind of continuing for the next year or so. But then after that, I do see the rents going up again, but not at the same rate that they've been increasing previously. But to be honest, I don't see that as a bad thing. It was just if they'd carried on the way they were going over the last 5 years, it just would have been completely unaffordable for all tenants. So we have seen a bit of a shift. There's a lot of more demand now for one bed apartments because they're more affordable for tenants.
yeah,
But yeah, I think rents they will continue to rise. I've never seen rents really drop at all really, but they will continue to rise, but just not at the same level. And I think we'll go through a period now over the next year where they kind of just level off a
stabilize.
bit.
Yeah. Liam, I suppose on that note, talk to me about in the different regions, sort of supply and demand, because I'm old. I've been investing since I was 19. My dad's 93, mum's 90, still investing. Property prices always go up, as Raj was saying, rental yields go up, driven by many factors. But talk to me about, I mean, we mentioned Birmingham, but I know we know we've got Manchester, Birmingham, Derby. We go different areas, but Birmingham's a stronghold. We talk about Birmingham a lot just because, from a mass point of view, it's giving you the capital appreciation and the yield. Talk to me about maybe planning, supply and demand, and what's happening in the Birmingham market.
Yeah, of course. I mean, like you say, Steve, we can sell anything anywhere. There is a pattern forming here that a lot of companies are talking about Birmingham, and it's no coincidence. It is all due to projections, capital growth, the rents that have stabilised and have got to a level now where they make the yields pretty promising. But I think the reality is, like Raj has just said there, over the last 12 months, there has been a relatively high supply of what we call build to rent. That's institutional investments in big, large scale rental only buildings. So they're buildings you can't buy into as an individual, mainly backed by pension funds. But when I say large scale, they're usually two to sort of 700 unit schemes that are all rental. Now, the good news is there hasn't been any build to rent deals actually done over the last sort of 2 or 3 years. So since Liz Truss's crazy budget, there hasn't actually been any deals done in Birmingham or many regional cities. So what that means is the supply of build to rent is actually going to stop probably middle of next year. So Raj will tell you that there's quite a bit of competition for rents because of the supply of these private buildings that are completing as we speak. That will sort of fizzle out, and typically they're very expensive, so they organically lift the market as well. But a lot of the private sort of boutique developments that we're all involved in, they're all privately occupied, so they're not all rentals, and they tend to sort of the rents get boosted on the a year or two after the sort of the build to rent supply. So that has kind of happened. We've seen that, and that's where the rents have sort of softened in Birmingham, and it's happened up in Manchester as well because there's a lot of delivery up there. But the reality is the supply and demand is still there. There are more and more people moving to regional cities. So as there are more and more companies moving to cities like Manchester and Birmingham, the students that are obviously moving to those cities to study, they're actually staying in those cities because of employment. So the retention levels for graduates are getting higher and higher and higher, certainly for Birmingham. And you've got new employers coming into the city. So just last week, Goldman Sachs said that they were going to, or they have announced that they're doubling their workforce in Birmingham. So they're going from a 500 person office to 1,000, and that is probably going to increase again the year after. That's happening all the time. So there's a lot of people relocating into the city, and they need places to live. We've done some research in Birmingham over the next 10 years. There is 19,000 homes, not just apartments, homes that could potentially get built within the city core and surrounding postcodes. However, the government's projection or need for Birmingham is 7,500 homes every single year. Now, if all of those 19,000 homes got built, which they won't, that's only an average of 1,900 every year for the next 10 years. Supply and demand, that's the way it works. Property prices are projected to grow on the basis and backed by that level of research. Now, a lot of those buildings, Andrew, are 60, 70 stories high. They've got planning, but no developer will ever build them because it's simply not viable to build. You can't sell for the price that it will need to sell for to be able to build at that height. So, you take all of those away, and that limits the amount of supply coming into the market, and that's just going to continue to push the prices. And in theory, in a year or two's time, once the rents have stopped softening, you'll probably see an increase in rents, like Raj has said.
Well, these big institutional investors are looking at a meeting with BlackRock. They've got 420, not million, 420 billion under management globally, not just in the UK. And they're looking at the key cities where we're investing in. Well, why are they looking at it? Because they know the demand is there, and they know it'll give a solid whatever net 4, 5, 6% return to their shareholders. And you've got the banks, big institutional investors are all looking at these schemes because it just makes sense from a financial point of view, where more and more people in rented accommodation. Yeah, of course, for financial reasons. Average age of the first time buyer in the UK, 36, 37 years old. Not only that, it's lifestyle choices as well. We all lease our music, rent our cars, etc., etc. So it's a big shift, as I say, for financial reasons and for lifestyle reasons. And in Birmingham and a lot of other places, Google it, 16 billion, this the big city plan. You've got the King's invested in land with the funds that he has. You've got massive, the Birmingham city centre, that at the Birmingham football, there's going to be a new £3 billion development. So there's a new sports quarter. You've got the largest commercial development outside of London. You've got a high-speed train coming 40 odd minutes into London. There's a myriad of things which will add to the problem with the limited supply, which is good. As I say, I've never known it. I've been in property a long time, and I've never known it so good in terms of limited supply and big demand. So thanks for that, Liam. What have we got here? Lee, are lenders becoming more selective about property types? New build, older stock, city centre? Are you seeing any particular changes? Any sort of lender criteria?
I wouldn't say more selective. I'd say each lender now that we do a lot of business with that specialise in predominantly the new build market, they do now specify more the types of properties that they will accept. So the number of stories that are in the building, what it's made from, the actual material, what fire rating it has. Is it an office refurbishment? Is it a brand new build from the ground up? You've mentioned city centres. Is it near a city centre? Is it near commercial property? Is there a rental guarantee scheme on it being offered by the developer? So it's one thing getting the client through the process of the mortgage, but the most important thing now, I feel, is getting the right valuer to go and look at the property, and also making sure that we approach the right lenders that will match quite easily with the type of property that the client's buying. So that's why it's really important that your clients speak to a professional that can guide them through all of that.
Yeah.
Rather than just approaching the cheapest lender that may not use the right valuer, and then your clients, losing valuation fees and money. So it's really important that you speak to the right type of people. But in the main, I would say, yeah, I tend to find, there's at least 10, 15, 20 lenders for each client, irrespective of what type of property they're buying. So if they're buying in a city, new development, there's going to be a really good host of lenders that we can go to get a really good rate. It's just key to pick the right lender.
Yeah, and I suppose as well, as I say, we've got some stock which is coming up to completion because the developer wants to wait until it's completed. We've got some stuff that could be sort of 15 months away if it's off plan. But even if it's off plan, typically you're putting down 20% up front. And there are benefits of why you should do that, but 20% up front, balance on completion. So they can always have a chat with you early just to say, yeah, as long as I've still got the same job, as long as my income's the same, then you're fit for a mortgage. So there's no surprises, 13, 14, 15 months down the road.
Yeah, you can glean enough information from the type of development it's going to be, from the developer. You can see how many stories it's going to be. You can look on Google Earth, see what other properties are around it. So there's not really much you can't sort of go through with the client to make sure that they're making the right decision. So that you can give them a good guide as to what the rate will look like, so that they've got the comfort of knowing that they're making the right decision with their investment.
Yeah. So a bit of research and a bit of talking to the right people up front. And there's no charge to talk to us. When you're talking property, mortgages, lettings, the market in general, just do plenty of research. Let's bring Raj in. Raj, if you had to give a new UK landlord a simple checklist for success in the current market, what's any sort of do's and don'ts, or any do's that you're seeing that works well that can increase the yield?
Yeah, so one that works particularly well in Birmingham city centre, because Birmingham city centre, bearing in mind it's a furnished market, very, very little demand for unfurnished. So in Birmingham, particularly, if you're going to furnish your apartment, do it to a high standard, or do it to a standard that reflects the apartment. So if you bought, a high-end apartment with, loads of nice facilities and it's, a high rent, then you need to, do a high standard of furnishing, where if you bought kind of a lower end apartment, then yeah, you can get away with furnishing it not as nice. But when I say furnish it to a high standard, I don't just mean the furniture in terms of the sofas and the beds. I mean just the little finishing touches to give it that show home look. So, a bit of wall art, rugs, cushions, maybe even wallpapering, because some of the walls to have feature walls, maybe in the lounge or the bedroom. So yeah, that's one big tip that I always recommend to landlords, and that obviously helps, you know, bringing in the demand and also, a higher rent.
Yeah.
Another thing that I always recommend is review the rents every year. So a lot of landlords or agents, they just kind of let the rent stay the same, and they think, oh, the tenant's been in there, been a good tenant, I'll keep the rent as it is. But, rent should always be reviewed, and if you do that, you'll be maximizing your yield by just keeping on top of it and making sure that you're getting the market rent every year. Another
Yeah.
thing that I recommend as well when a landlord has a property available for rent is don't just market at the highest rent to get the highest rent possible. Market the optimum rent, so that the rent amount that gets you the highest rent, but in the quickest possible time. Because when you factor in, void periods, suddenly your annual income, diminishes. Whereas if you get, a decent rent, it might be £50 less than the top end, but your overall income over the year will be a lot higher.
Yeah, because if you're hanging out for an extra 50 quid, you might lose 1,500 quid waiting for that extra
Yeah,
50 quid for the following month.
yeah, absolutely.
Yeah, cool. And I know we used to do split tests. We had the same apartment, mirror apartments on the same floor, and one we spend, I don't know, five, six, seven, 800 quid more in furnishings and bits and bobs, probably more than that today. But you get £200 a month more because people are buying into that sort of lifestyle, really, aren't they?
Yeah, absolutely. Just something that tenants can move straight into and not have to do anything to it. They don't have to worry about, dressing it and making it a bit more homely. It's already like that from the day they move in.
Brilliant. And it does vary area to area. I know we've got something in Derby, and we use one of the local agents up there, local Martin and Co. And they're saying, half of what they're doing is unfurnished. So I think maybe it's just got a longer history of people that have got their own furniture that are in long term,
Yeah.
what's the average tenancy agreement, right? Are people, I mean, back in the day, people say a year or 2 years. I guess with the way the world is, the way the market is, people are staying a lot longer in their rented properties.
Yeah, I'd probably say in the market we're working in, it's probably a couple of years. You've got a mixture within that, obviously people staying for, 10 years plus and, the odd tenancy where they literally just stay 6 months. But yeah, majority, I'd say couple of years.
Yeah, and for me personally, as a landlord, I quite like it when people leave because I'm a bit of a soft touch. So it's quite nice because that's an easy way to put rent up. But you need a good, strong agent that will give you the right advice and manage that, which I think is really important because you don't want to be missing out. And again, I know something we talked about earlier with the new the renters reform. You're doing all the credit checking. Has that had much of an impact, the new renters reform bill that's come in?
So it hasn't had any impact yet. It will have an impact, but not. It's more the impact it will have is more just kind of knowing the laws and following the new laws come in. I don't really think it will impact the market as much as maybe some landlords fear. That there are a few things to consider really as a landlord is, you're going to be kind of there's only certain reasons that you can serve notice on the tenants. But then reasons are reasons that most landlords would want to serve notice on the tenants anyway. So, there's going to be changes, but nothing nothing too disastrous that makes it non-viable being a landlord anymore, which I have had concerns from some landlords saying, shall I sell up? Maybe it's not the time to be a landlord anymore, but it's definitely not that bad.
Yeah, I know you're buying, I'm buying. I know we're all still investing. On that note, Liam, I know you do a lot of research. I'll say we have a research team. We've got a research person, but Knight Frank have massive people, massive team globally. Tell me what you're thinking about for capital appreciation, rental yields over the next, maybe to the end. Sounds like a long way off. End of the decade, and end of 2029.
Yeah, well, it's going up, and it's not coming down. The rate that it goes up will be determined by what Lee said earlier about sort of the base rate softening slightly. So that's probably where we would see that recovery. So transactional levels have slightly dipped, but that doesn't mean property prices have dipped. The national UK price has gone up by about 3.5% this year. Places like Manchester, Leeds, Birmingham, they have outpaced the national average. But year on year, we're sort of factoring in an average of 2% across the whole of the market. And then there are some regional cities, like I say, that will outpace the rest at sort of your 5% year on year growth. Just be completely independent outside of what we say. So JLL, who are in theory our competitors, they're saying that Birmingham will be the number one out of the top six cities at 25.5%, I believe, between now and 2031. I think a lot of that growth will be underpinned on HS2 and the delivery of that. Obviously, Birmingham is the only city that affects now, being direct to Birmingham to London. There is no phase 2 or 3 going to the north, so that is massive for Birmingham. But I think the base rate will have a big factor on transactional levels next year. I'm not quite as optimistic as Lee about the base rate dipping in December. It'd be amazing if it did, but I'm not sure that's going to happen. But I am of the same opinion. If it can get down to around 3.5%, 3.25% by the end of next year, I think that's probably where the new norm will end up being. Remember, a lot of lenders will lend under the base rate. So, if you are an investor, my advice right now is put a bit more money in, increase your deposits, try and access a slightly better rate, take the pain for the first 2 years. Don't wait until the base rates come down, because the property prices are going up during that time. So you are going to pay more for the property in 2 years than you would on the length of a mortgage rate over the next 2 years. So that would be my sort of personal advice. But look, I think what we've got right now is transactional levels have slowed slightly, but prices haven't dipped. That just shows you how robust the market is in the UK. We're not just talking about the last couple of years, we're going back decades and decades and decades. There's always a slight correction in the market, and it just keeps going up again. And that's due to pent-up demand. Raj said about COVID and lettings, that was a year where nobody could really transact or move, and then it just went boom. And I think that is going to happen when the mortgage rates come down to a level where people are comfortable at. The cost of debt kind of makes that investment a little bit more sort of profitable. And then again, transactional levels will go up. And what happens when transactions go up? Prices continue to go up, but maybe at a slightly faster pace. So if you want to get in before that happens, just buy now. Q1 next year is a great time to be doing it. Everybody knows what we're dealing with regards to the budget. That wasn't as severe as people thought. It's a bit more normality in the market. I think that would be a great time to start sort of striking on an investment.
Yeah, I think the fundamentals are there because the JLLs, the Knight Franks, the Savills reports for the top key cities, you're looking at about 20 to 24% capital appreciation from now until the end of 2029. You're looking at rental yields increasing on average, depending on the report, 2-3% in various areas. And again, the best time to buy is always now. I bought something 2 years ago. Well, that'll be 2 years in April. I got a mortgage rate because I'm maxed out. I'm a big fan of leveraging. I paid my mortgage rate is 7.09%. So we do detailed cash flow summaries, and we can share that with you. So we want to make sure, after fees, charges, stamp duty, solicitors, whatever, that you're cash flow positive every month. I've got stuff. This one I bought at 7. I'm probably underwater by 100 quid a month. But guess what? I wanted the property. It's gone up. It'll be 2 years ago, April 26th, when I got the mortgage on it. And it's probably gone up 45 grand. And I'm in the process now, because it takes a little while, of remortgaging it. And I'll get it down to whatever, 3-4%. So you've got to look at the longer picture. Probably, I say you want to hold it for a minimum of 5 years with stamp duty. Hey, if you need to sell, we can sell it for you. If you need to cash in, you can do that. But the longer the hold, the better. Most people, if you're investing in a limited company, they'll just put the money in, they won't draw the money out, and they'll rinse and repeat, and they'll just buy more property. So yeah, it's just a case of being brave. I had stuff back in the day with my dad. 50 mortgage rates. I don't know if Lee remember 15%. Lee.
No, it's too long ago that, Andrew.
Yeah.
Even for me.
Okay. Sorry about that. Yeah. I need to retire sooner rather than later. I think my cultural points and reference points are not keeping up with you youngsters. But yeah, look, my dad bought his first house in 1960 for 1,900 quid. Still got that property. The mortgage was £1 and a shilling. My first flat I bought was 19,000 quid. I've still got it. So, as Liam was saying earlier, on average, every 10 to 13 years, property prices double, despite trusts, Trump, COVID, wars, 2007, 2008 recession, etc. So yeah, it's just a case of being in it for the longer haul, really. I'm mindful that I'm wittering on. Have we got any questions? I mean, we've covered a few of they as they've come in. Is there anyone that's got any particular questions that we can answer while you've got the panel here? If not, I'll just cover the budget, which we saw, and as Liam said earlier on, pretty straightforward in terms of to strip it back, you're probably paying 2% more with the increases in taxation. Nothing really scary, was there, Liam, there?
No, I think obviously no one likes tax increases, but obviously property investment, the fundamentals are still there. You're going to get an extra 2% tax on your rental income, which obviously isn't ideal. But it is still one of the only investment classes where you can use a bank's money to invest. Until that changes, I can't see people's appetite for property diminishing. But it isn't a short-term thing. You're right. It's 5, 10, 15 years. The longer you have the property, the longer you've got someone paying off the debt, i.e. the mortgage, the rent is paying off the debt. So yes, it's not maybe as profitable as it would have been 3 weeks ago. But look, they didn't increase the stamp duty. There's no additional levy for investors as to what there currently is now. So I think next year I can't really see they're going to be putting any additional sort of stress on investors. I think that is the most painful it's going to get. So it's nowhere near as bad as we thought it was going to be.
Cool. And I think it's 60 odd more now. 60% of our investors are buying in limited companies. Probably even more important now because there's capital gains advantages, inheritance tax advantage. If you're long-term planning, we can help. We've got specialist tax people that can you can have a chat with. We've got people that can help structure that limited company. You can claim expenses and mortgage relief. So again, it might only be hard. It's small percentage points that you're saving in terms of tax, but again, over the long haul, particularly if you're building long-term wealth for family, for kids, then again, we can help and advise there because again, saving 0.5% here, 1% there makes a big difference. Anything from you guys, Raj? Anything you want to add on the rental side? Have I missed anything there? I think we're done on the questions, unless anyone's got anything else coming in.
Just before you start, thanks so much, guys, for all of the information this evening. It's been really, really useful. But I was just going to pop a poll on screen.
This is a nice bit of interactivity. Here we go. Oh,
sorry, I'm back.
Yeah.
I don't know what's going on. It's all.
You're frozen.
I froze.
Yeah, we can hear you. Maybe just dim the video because it might be using up a bit of bandwidth to your side.
1 second.
Yeah, cool. So it was only like if you've got there'll be a little poll question that will come up in a minute, and it's if you want to, you can click on. It should come up in a second, but you click on one of the boxes if you want to speak with Raj on the rental side
you
of
carry
things.
on, Andrew, and then what I'll do is once this stops loading, I'll pop it on the screen for you.
All right. So it'll be if you've got a question there'll be a box there if it's a question for Raj. So anything you need on the letting side, tick the box. Anything for Lee on mortgages, past, present, or future mortgages. Anything for Liam or myself about the market. As I say, we have developments from about £148,000, giving good rental yields. We do detailed cash flow summaries. We've got guides on our website. We've got all the previous webinars, so there's tons of information there. And you feel free to contact us for any further information. I don't think we're going to get anything, are we, Han?
No, it's not responding, but I can't end it because then the whole webinar will end. So I'm just going to
wait. We've done 180 webinars. This is the first time we've had a problem. But hey, look,
Yeah,
you know where
I've
we
got a
live.
blue circle on the screen, and it's just it doesn't want to play ball.
Don't worry. You know where we are. You know where we live. We'll be following up with an email or a WhatsApp tomorrow. So if there's anything you need, if you want a copy of the webinar or any further questions or anything, please let us know. And I'd just like to thank Liam. Thanks for giving up your evening and coming on and talking about the market. Raj on the rental side, thank you, and Lee on the mortgages, and yeah, and Hannah for
freezing the webinar.
for Hannah for messing everything up. Appreciate it, guys.
All right.
Good.
Thank you very much.
Night,
See you soon.
Thank you.
Thanks.
Thanks,
Cheers.
guys.
Bye-bye.
Bye-bye.